All right, today we are going to unlock the 3 secret keys to understanding pretty much all of business finance. Yep, we're talking about the golden rules of accounting.
So, if you've ever felt your head spin trying to figure out what gets debited and what gets credited, trust me, you are not alone. It is a super common stumbling block, but I promise by the end of this, it is all going to click into place. Because here's the secret, right? All of that complexity, it really just boils down to 3 simple, totally logical rules. There's a reason this system is the foundation of modern finance. It creates this perfect, self-balancing picture of every single transaction. Master these rules, and you're going to see that picture with complete clarity.
Okay, so the very first step is to understand that every single account in the world, I mean everything, from the cash in the bank to a giant factory, can be sorted into one of these 3 categories: real, personal, or nominal. Everything fits. So let's start with our first category, real accounts. I like to call this the what you own rule because, you guessed it, it deals with every single asset a business has.
So what is a real account? Well, it's an account for any asset, whether it's tangible or intangible, that has a life of more than 1 year. You know, think of stuff you can actually touch, like cash, laptops, or buildings, but also things you can't, like a company's goodwill or a trademark. If the business owns it and it's got long-term value, it's a real account.
And here it is, the first golden rule. It's so simple. Ready? Debit what comes in, credit what goes out. Anything that enters the business is a debit. Anything that leaves is a credit. Let that sink in for a second. Debit what comes in, credit what goes out.
Okay, let's see this in action. Let's say the business buys some furniture for $5,000 in cash. Now, here's the key. Both accounts here are real accounts. Furniture is a long-term asset, and believe it or not, so is cash. So what's happening? The furniture is coming into the business. So we apply the rule, debit what comes in. At the exact same time, cash is going out of the business. So we credit what goes out. See? Simple, right?
All right, on to our second category, and this is where you'll see how these rules start to build on each other. We're talking about personal accounts, or what I call the who you deal with rule. This covers every single person and organization your business interacts with.
Now, personal accounts come in 3 different flavors. You've got natural persons, that's individual human beings like you and me. Then there are artificial persons, which are legal entities like a bank or another company. And then there's this interesting one, representative accounts. The easiest way to think of this is like a WhatsApp group. Instead of making an account for all 1,000 employees you owe a salary to, you just create one account called outstanding salaries that represents all of them.
And the golden rule for personal accounts is this: debit the receiver, credit the giver. Now, the absolutely crucial thing here is to always think from the business's point of view. Who is receiving value? Debit them. Who is giving value? Credit them.
Let's look at a credit transaction to see how this works. The business buys a laptop from Neha for $70,000, but hasn't paid her yet. Okay, 2 accounts are affected, the laptop and Neha. The laptop is an asset, that's a real account, and it's coming in, so we debit it. Easy. Now, Neha is a person, so she's a personal account. At this exact moment, is she receiving or giving? Well, she is giving the laptop to the business, so we credit the giver. Her account gets credited.
On to our third and final category, nominal accounts. This is the how you earn and spend rule, and it tracks all of your day-to-day business activities.
You see, nominal accounts are for all your expenses and incomes, the things that are basically consumed or generated in the short term and don't create some lasting asset. So paying salaries, rent, or travel expenses, those are all nominal accounts. And so are the revenues you bring in from sales or any commissions you receive.
And our final golden rule is probably the most straightforward of all. Debit all expenses and losses, credit all incomes and gains. It's that direct. Every time the business spends money on an expense, it's a debit. Every time it earns income, it's a credit.
And this example is just perfect because it shows how all the rules work together. Okay, we pay a salary of $25,000 in cash. Salary is a nominal account. It's an expense for the business. The rule says debit all expenses, so we debit salary. Now the payment is made in cash. We already know cash is a real account, an asset, and it's going out of the business. And what did our first rule say? Credit what goes out, so we credit cash. See how it all just connects and balances out perfectly? So there you have it. 3 types of accounts, 3 simple rules. Let's put it all together on one final cheat sheet. This is the big aha moment right here.
This is it. This is the entire foundation on one slide. For real accounts, debit what comes in, credit what goes out. For personal accounts, debit the receiver, credit the giver. And finally, for nominal accounts, debit all expenses and losses and credit all incomes and gains. You know, it might have seemed like rocket science before, but really it's just a perfectly logical system. Once you figure out which bucket an account falls into, the rule tells you exactly what to do, every single time. By really getting these 3 golden rules down, you now hold the keys to decipher literally any business transaction. So the only question left is, are you ready to become a journal entry champion?